All right, well, thanks so much for having me here today. And what I'm going to talk about is, how you can trade uncertain markets. And so we've been in a little bit of that lately, right? And this is using, what I call high, return, low risk option strategies, the butterfly and long condor. So they're very, very unique, and I think you'll really get a lot out of these two strategies that I'll go through here today. So the following presentation is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. So, I've been trading options now for over 30 years. And, what I've found is that the most valuable go-to option strategies that can really literally help any trader or investor out there more than any other strategies, known is probably, especially during the extreme market uncertainties, are the option butterfly and the long condor. So they're kind of my favorite, kind of what I call my trading secret weapon. And so these strategies, they can work no matter what the markets are doing. We could be in an uptrend, downtrend, or sideways market action. Can provide income from stocks that are going nowhere. Really helps to eliminate the stress of having to be perfect on a stock's direction or overall market. Helps to, basically eliminate the time decay. So you're going to get positive data on these two type strategies and eliminate that time decay expense that you encounter from decaying options. Helps to take out the unsettling guesswork out of your trading. You don't have to be exactly perfect on the market entries and exits all the time. And really an unmatched hedging strategy that you can use to hedge out core positions such as credit spreads or debit spreads, things like that. Now, they can also be structured for very low cost and very low capital at risk. So you can get, returns of literally 15 to 1 or higher. And I'll show you some really good trade examples of some really high return trades that we've gotten, using the butterfly. Now, the butterfly is fairly simplistic structure. It's kind of a combination of vertical spreads. So here's an example of a butterfly setup. So this would be like if you had a call debit spread. So you're long a call, short a call, and we're long that call at this 10-10 strike right here, and then short the 10-20 right there. So it's a $10 wide spread, so $1,000 wide. Now, the debit cost on this trade is $300. So that's your risk on this trade, a debit spread. So a very nice vertical debit spread. And your potential profit would be $300 or $700 if it closes above this 10-20 strike price at expiration. So that's your risk going in, 300. Now we can even reduce that risk, and also with this spread, the call debit spread, you're going to have a negative theta. So if the market doesn't move in your direction when you need it to, you're going to start losing on the debit cost that you pay. So what we can do if we want to offset that, we could quickly add a credit spread to it. And in this example, I could sell a bear call credit spread. I could sell a short that 10-20 strike and buy the 10-30 strike, so we're protected if it goes up, so we're not naked short here. And then what I've done is I've brought in a credit of $200. Now that with the credit spread in this example, you'd have a spread width of $1,000, $10 wide spread. Your credit received or your premium is 200. So your potential risk on this trade then is 800. So this is what we call a negative risk ratio. But when we combine this strategy or this vertical spread together, now we've created what we call the butterfly. So now we've gone from that risk of $300 from the debit cost here. We've added that credit spread here, 200. So now we've knocked down the risk, and all we have to risk here on this trade would be $100. So we've got that max risk of 100. The spread width is still $1,000 wide, and now we've dropped our spread to a risk of 100. So potentially, if we go out at what we call the top of the tent here, we would have a $900 profit, which would be a 900% return. So that's the beauty of it. Now you also have your profit anywhere inside this profit zone or profit tent. So that's the basic kind of outline or the risk profile that you get from a butterfly. And then the long condor is similar. It's kind of what I call the cousin to the butterfly. But what it does is it's going to widen out the profit zone of the trade. So instead of having that really tight window to thread, that needle to thread here on the butterfly, we can widen the profit zone out here to have a larger zone of profit, but we're still going to have a very reduced low cost risk trade, and also we'll have positive theta. So these two strategies are always going to give you a positive theta trade. So you don't have to worry about, your trade, markets going sideways and you start losing on that theta decay. Now, the core concept that really make the butterfly and long condor dynamic is really, when we look at it, are the two main option pricing components. So, the key, or the main one, is going to be the understanding time decay. So the butterfly and long condor really take advantage of reducing that time decay, and like I said earlier, in putting this into a positive, time positive theta value versus a negative theta value. So let's take a, kind of a quick review of this core concept of time decay. Now, what theta does, it tells us how much an option price is going to go down or decay over time. So this is the rate of the time decay of your stock option. And by expiration, that theta goes to zero. So the two main kind of components for your option pricing will be time decay, or theta, and the other important one is implied volatility. But at the end of your option cycle or series, they both go to zero, and this is what we're taking advantage of with the sell side component of either a butterfly or a long condor. Now, the butterfly spread, here's a kind of an example of how you can see what the math looks like. So here's like XYZ, and it's trading at $45. And we're looking for a price move down to 43, just not a huge move, but just a kind of a move down to 43 in this example. So what I like to do with the butterfly trade is I put a target, a price target. I like to use Fibonacci, moving averages, some other things I look at, but I put a target that I'm looking for, and then that target becomes what we call the body of the butterfly. So right here, so we're going to target 43, and that's going to be the butterfly body. So in this example, could go out and buy the February 44 put. It's going to cost $2.38 or $238. And then I'm going to sell below it. This would be a put debit spread. I'm going to sell below it the 43 put. I'm going to bring in $1.67. So then I sell that $1.67 again, and I buy the 42 put. So now I've got a dollar wide butterflies, 44, 43, 42. So very narrow winged butterfly like this. But what I've constructed is this dollar wide butterfly, and I've got here this potential top of the 10th. That's your body. So if it goes out at 43, that's going to be your max profit. Now, by doing this trade, you can see how low the risk is. So I've got $238 for that 44 put, $1.06 for that 42 put, and then I brought in a credit of $1.67 twice for selling that 43 put, times 100 to make it equivalent to an option contract, and so that's $10 per option, butterfly spread. That would be your total risk. Now your profit is just basically take your middle strike less your lower strike, and then your less your net debit, so times 100. So in this example, you can see it's a dollar wide spread, 43 less 42, and 44 less 43. So each spread, each strike is $1 apart, less your cost of the trade. In this example, $10. So your potential profit would be $90 per spread, or potential return of 900%, or risking $1 to make $9. So it's a really great trade setup, and especially think about it when you're in a really high kind of volatility market with a lot of uncertainty. You can really keep your risk super low by doing this type of trade setup. Now, the next thing to look at is, what are the best option strategies? So in my opinion, one major goal for every trader really should be to select the trades based on what's going to provide you the most consistent positive returns over time with the low defined risk, and not always the greatest. So, what I always advocate and teach my customers and my clients and members is, we're trying to look at our trading to hit singles and doubles, and then occasionally we're going to hit that, home run, so we can have a nice smooth equity curve doing that. And so that's another great way to add a butterfly or long condor to your trading plan, because you're going to get these low risk trades that can also hand you kind of a home run kind of trade from time to time. Now, one of the best ways to achieve your goal of what strategy to use is to understand the option strategies that are out there and available then how they work, and then select the one that's going to be best suited for your trading environment and your specific trading goals. So when we look at the butterfly, I call it there are a lot of variations of the butterfly. They both, this butterfly strategies are, selling time and volatility are a big part of it. So we have what we call, the variation. We have a long call or put butterfly. We have a broken wing butterfly that we can do with calls or puts. We have what I call the ninja unbalanced ratio butterfly. We've got an iron butterfly. We've got the lotto butterfly, which is really cool. I'll show you a couple examples here in a minute of that. And then a whole another area is just your hedging. So these are great for hedging, great defensive strategies for hedging your various vertical spreads, credit spreads, debit spreads, etc. So it really adds a great risk management tool to your hedging as well. And then we have what I call the long condor option spread, which is what I refer to as kind of the cousin of the butterfly family. So these are kind of the variations. So, what I thought I'd do next is kind of go through some different examples so you can get an idea of what the trades look like, and what they can do as far as, helping you with defined risk, but, still offering you big, nice returns on your capital. Now, when we do a butterfly spread, we can adjust the risk and the profits based on the wingspan of the butterfly. So, if you're, collecting butterflies, which maybe somebody out here does, it's going to be a lot easier to catch a butterfly with a really wide net versus a small net. So we can really kind of basically control our risk and increase our wingspan to increase our profit zone. Or if we really want to tighten it up to really reduce the risk, to really keep it tight, we can make a narrow wing butterfly or a wide wing butterfly. So that's how we reduce, and adjust risk to profit based on the wingspan of the butterfly. Now, here's an example of a directional long butterfly with a narrow wing butterfly on SPY. So butterflies are also great for, the index options such as SPX, NDX, things like that, or great on the ETFs like SPY, QQQ, the Russell 2000. And then just great on stocks in general. So, if we have good liquidity, we can do butterflies pretty much on anything, and you can do butterflies on futures, crude, whatever you're trading. Now, here's an example of a very narrow wing butterfly. So this was on the ETF SPY, and so this was just a really short-term butterfly. You entered into it on the 14th of February, and the exit was going to be the expiration day of the 16th. So SPY in this example, when it was trading at 273. So I like to use Fibonacci for my kind of price targets and different price points to be hit. So this was from a high to low, and we had a good area right here at that 618 retracement coming in around 273, 274. So there was a lot of kind of good resistance there. There was a lot of option activity going on. So that was the target for the butterfly. And so for doing this butterfly, then targeting that price point, did the body of the butterfly at the 273. So went out and bought the 272 call, sold the 273, sold the 273, bought the 274. So these are, hedged, defined risk trades. So you don't have to worry about, short strike or anything. And so this was done for $10 per butterfly spread. So then you can see the spread width is $1 wide between the strikes. So $100 would be your spread width, less the cost of the trade of $10 here, 10 cents or $10. So you've got your risk then of 10, and then your potential profit is $90 per spread, which would be, if you hit that at expiration, a 900% return, or risking $1 to make 9. Now this trade example, actually, we went out and made $70 per spread, which is a 700% return in 2 days. So you can see the top of the tent here. You can see that little black area is what's still potential profit, but the trade was right here when it was trading right here at 273.08. This trade going into expiration on that day went from 10 cents to 80 cents or $80, and there's your profit of $70 per spread, or 700% return. So on 4 contracts, that's $280. So a really low risk way to make money and just keep your risk at super tight kind of levels in that trade. Now, what we typically, the most of the trades we tend to do are more so wide wing butterflies. So the wide wing butterfly is going to really help you to give you that, wider profit zone, structured again for very defined risk, great for hedging, used again for targeted directional swing trades, medium-term trades. It could be, 1 day to 2 weeks out. That's kind of the sweet spot. On the butterfly, I don't like to go more than 2 weeks out, because you basically you get with the way the structure works is you've got kind of dead money until you get close to your expiration. So typically we'll go maybe 5 to 7 days out, something like that. I'll show you a lot of examples here in a minute. But these are also great for what we call a directional penny trade. So when we have when you have at the expiration, when you have a certain strike, let's say you've got XYZ and you've got $100 strike price, and it actually goes out at expiration right at $100, that's what we call a pin. So it pinned at that $100 strike price. So these are really great for a strategy that I'll show you where we can take advantage of potential pin at certain strikes. Great for high volatility markets because again, when implied volatility goes up, that increases the price that's one of the price components. So that increases the price of your option. So when it goes up, that's going to be a benefit to the butterfly or a long condor because we have that sell side component. Great for high volatility markets because we can keep our risk super low. So kind of trade duration again, 1 day to kind of 2 weeks out. Again, positive data, no time decay, and potential returns. You can get 2x to sometimes 20x or more. So I'm going to show you some ways that we've done that on a couple trades. Okay. Now here's a really good example that I like to show, and this one is on Amazon. So then this example, what this will show you is how you can trade a really high price stock with very low, risk, directional risk because of the way we'll set the structure up. So this is back when Amazon, before it split, but this was back when Amazon was trading, $1,700, close to $2,000, per share. So this is $1,000 wide spread. So very wide, $10 wide spread, or which would be $1,000 wide spread. Now the trade setup here, Amazon was, just really bouncing around. This was a 200-day moving average. So it was just really churning around this moving average. And so we were looking for it to eventually break to this area up here, to this next resistance area, 1830. So I wanted to set up a trade targeting 1830. So this trade was set up like on the 29th of August when it was trading at 1782, and we were going to target 1830. Now, if you were going to, buy 100 shares, so remember one option contract is equivalent to 100 shares. So if you went out to buy, 100 shares of Amazon in this situation, you're going to be out of pocket over $178,000 basically to do it. So with the butterfly, though, we can play these high-priced stocks and make them super, super low risk and also very, very inexpensive. So here's the butterfly spread setup targeting that 1830. So went out and bought the 1820 call, sold the 1830, so that's a $10 wide spread there, and then sold the 1830, bought the 1840, so 10 there. So it's a balanced butterfly, $10 wide or $1,000 wide. Now the cost of this trade was 80 cents. All right, so that's your debit cost of 80 bucks. Spread width is 1,000, so less your cost of the trade. So potentially you can make $920 if it went out at your body of that butterfly at expiration. So 920, on your risk of 80, that'd be, over 1,000% return. So risking $1 to make 1150. Now, if you did the shares and you hit that 1830, you would be at $48 per share, but that's 2.69% return. And you've got a lot of potential risk there, over 178,000. I mean, if it went down, that's going to be very painful. But here, what your risk is, it's 80 bucks. That's all. You don't have to worry about getting destroyed by that one trade. So the other really neat thing here is how the time decay and volatility work in your favor. So here it was at expiration. This was on the expiration day, and this was in the AM. Okay, so this was at about 9, 10 o'clock in the morning. So you can see here it was hitting close to the target, not exactly. It was at 1836. So we want 1830 would be the perfect pin or perfect, option, where we go at expiration. But right here in the morning, first thing, it was trading right here. You can see that purple line is where it is in time. So at that point, it had gone from 80 cents or $80 to $230. So it's still up $150 per spread, and that's 187% return. So it's still not, bad. A very decent return on a very low at-risk type of trade setup. Now, all that black area is what's potentially left in the trade as far as your time component, that makes up part of the trade and the implied volatility. So it's got a huge amount of potential profit still in that trade. So here it is in the afternoon. So this is a really cool thing about it in the afternoon. Now it's, you're sucking out all that time and implied volatility. And at the end of the expiration, at the end of the day in this series, those two price components go to zero. So that's a really big part of the profit. So you can see here just, later in the afternoon, now this trade had gone from 80 cents and now it was trading at $600 or $6.95 or $695, which was a 614% per spread profit, or a 769% return, versus if you'd done the stock, it would have been a 2.69% return. So, in the morning, you had a profit of 150, which was not that bad. And that would have been a, return, you were looking at 187%. But just a few hours later, now you were up 614 and are over 700% return, and the price had not, it was right there at 1832, about the same area. So that's the really huge, dynamics of the butterfly. Now, here's the other one that we use a lot at Power Cycle Trading. This is what we call the long call condor, which is not an iron condor. It's a long condor, which is a combination of a debit spread and a credit spread, and not two credit spreads like the iron condor. So this is one that we'd set up on Apple. So we were looking for an upside move on Apple. This is around the 21st, and we were looking, it was trading at 228.80. And so we were, when we took it off, it was back trading up to 235. So we put the trade on here, right around that 228 area. And these are my indicators that we used based on momentum. We had what we call cycle reversal with momentum on the upside, and we had a Fibonacci break through this level here. So we were looking for potential move higher. So we set this trade up super low risk by using the condor to kind of cap the upside, kind of give us positive theta, bring in a little premium. And so this was the trade setup that we did on this. These are alert trades. I've got alert service that sends out these types of trades, but we set this trade up, and again, it was traded at 228. So what we did was we went out and bought the 230 calls, sold the 232.5 call. So that would be like your call debit spread like this. And then we sold against it the 237.5, 240 call credit spread. So that adds that to it. So with this type of strategy, we can leg in, leg out, or we can do it all at once. In this particular trade, we did the whole trade all at once. And so got into the trade for $82. So 82 cents, $82 on this long condor. It's going to give us also a positive theta, no negative theta. So the potential profit then is your spread width, which 250 or 250 bucks less that cost your trade. So potential to make $168 if it goes out here, which is a return of over 204%. So really nice return on that, and no time decay, positive theta, and less stress because we've really defined and sharpened up our risk. All right, so here it went out from 82 and now it's trading up to 249. So there's our profit at 249, the spread blew to 249. So we're up $167 or 203% return on this trade. And so here's all the profit zone in here. Now your risk then, if it was to blow out to the upside of the leg here or to the downside of that area, then your risk is $82. But anywhere in here, you're gonna make a profit. And this went out right where we needed it, right between the two spread strikes. So that worked out perfect. So that's a long call condor. And again, we can do these trades with if we're looking for a downside move, we can do it with a put condor or a put butterfly. So we can just structure the trade based on the direction, either using calls or puts. Now here's what we call my lotto ticket. So this is where you can add this kind of trade to your trading portfolio to keep really low risk trades, but give yourself the chance to make a huge potential return like you're hitting a lotto ticket. So this was one of my members, Bill, and he said, the butterfly strategy is one of my favorites. It's the big winners that eventually make the difference in any trading account. So with the so-called low risk option strategies being sold to the public, an account without the potential to hit that big one in a while not betting the farm is a slow ride up the long hill. So this strategy, though, is like ABC. So here's one that we did. These were alert trades that were sent out. And we set this one up. This was like on the 8th of February, and Tesla was trading at 189.35. And we were setting a target for 200 for a pin, for an option expiration pin at 200. So we did this, based on a lot of things that I look at to do these types of trades, which will be, you're going to get a chance if you're interested later here to buy this butterfly course for super low cost. But this is one trade that we did to outline in this course to show you how it's done. So went out here and bought the 197.5. We were targeting the 200, and then sold the 200 again and bought the 202.5. So it's a $2.50 wide butterfly. We did this for 12 cents. Look at that, 12 cents or $12. That's the total risk. So if you totally, got it totally wrong, you lose 12 bucks. But the potential profit here, you've got that spread width of 250 less your cost of the trade 12, you can make $238. That's a 1,983% return on that trade due to that super low risk. Now, here it was where it went out. Now, when we do these trades, we'll scale out, and save a little bit for the, very last day, because they can bounce around, but this is where it went out the very last day. This was a pretty amazing trade. So it went out exactly at 200. So very rarely do you get that perfect pin, but that was a perfect pin. So this went from 12 cents or $12 to the max profit of 250 at the top of that 10. That was a 1,983% return where it went out on that day. So super, super big, payoff on that over just an 8-day period. And this gives you that positive theta. So while you're waiting the trade out, you're not losing on that theta. And if you're totally wrong, that's why it's a lotto trade. Your risk is $12 or 12 cents. So super great way to trade that trade if you want to take your risk to a different level, very low level. Now here's another one that we did, and this one was on a GLD, which can be a really good one as well. So this was the gold ETF, and this was another trade alert setup that we sent out. Now GLD, we were looking for a move to 225 or 230. So this was trading when we set it up at 222.85, and then the expiration that we were looking to pin it on was the 16th of August. So. And it did go out trading right there at 230.47. So this trade was up $203 per spread, or 700% return, in that 8-day period. So set it up right here where it was trading at 222.85. So trading right there, and then we were looking for this 230 area was where we were looking for the pin. Now this was based on an expiration of the kind of the monthly option series right here. So that was the target, and then set this trade up, and so set the trade up with our body of the butterfly at the target we were looking for, 230. So did the 227, 230, sold the 230 again, bought the 233.5. So we had this $3 wide butterfly, or $300 wide spread like this. Cost of the trade was 29 cents or $29. And so then our potential profit, if we hit that top of the temp here, was 271. That'd be a 934% return. Plus, it's a positive theta trade. So we have no negative theta, and we just sit with the trade. So again, the kind of the strategy here is you know what your risk is super low, and you just sit with the trade and going into the expiration. So, a lot of my members, they love to do these trades. They'll always have a few of these kind of trades on. In order to give yourself the potential to hit that really big home run, to add that really big spike in your equity curve on your trading profits. So here's where this one was going out, and this was right here, not a perfect pin, but very close. It was going out at 230.47 right in here, okay? So went from 29 cents or $29 to $232 right here. So this trade went from 232 to 29, so it was up $203 per spread, or that's a 700% return in that 8-day period. So these are some really great ways to take advantage of, a trade where you can keep your risk extremely low, but have the potential for big payoff, on, a pin at a certain level. But if you're not right, you still have a huge profit zone for a really good return. And when you think about it, whatever you make on that small amount of capital is going to give you a big return on that capital at risk. So, I hope this was some really good stuff that you can get a good idea of, what these kind of trades can offer to you as far as your trading portfolio, or even for your investing if you're looking at it that way. So if you'd like to learn more on how to master these high reward, low risk strategies, option strategies that can work in any market environment, I've got a really good special for everybody here. And if you'd like to take advantage of it, use this link here. I'll put it into the box real quick here. It's already in, so thanks for putting that in. So yeah, just use that link there, and you can click on it and or copy it and pull it up. And what you're going to get here is my Butterfly Long Condor Option Masters course. So this is one I did back right at the end of December. So it's a really new course. So what you're going to get is the on-demand 6-hour recorded course specifically on the Butterfly and the Long Condor. So you're going to get with this a follow-up live Q&A invitation, and you'll get the PowerPoint with which is the training manual, plus another 5 different bonuses here. So with the course, you're going to get the course, okay? And so this course on my website is $397. If you sign up here today, you'll get it for $197. But you're also going to get my another option trading course I did, and this one is Start Trading Options Today. So you'll get that on my website. That's $197. I'm also going to throw in a 30-day trial membership to my trading club. So this is where you come into my trading room, my virtual trading room each and every day, attend our virtual Q&As and a lot of other nice benefits. So you get access to that for the next 30 days. Then if you decide you want to stay on, it's $97 a month, or we have some other packages as well. And so then we'll do a live follow-up Q&A. You'll get a invite to that. And then you're going to also get another option trading tutorial and my option strategy manifesto. So 15 other option strategies. So a really good bonus package here. So over $1,000, but today everything's $197. So just use that link there, and you'll get this thing sent to you right away. Now, what you're going to get here is the course that I did. This was in December. So it's a 6-hour plus recorded course broken down in 30-minute modules with the 456-page training manual with trading library of a lot of different trades that you can look at, butterflies. So it's really a great step-by-step blueprint course on these 2 strategies. So you're going to get that. And then here's from one of my members said, excellent class, Larry. As usual, you underpromise and overdeliver. I wish I'd known how to do this hedging before I lost so much money on my credit spreads. So with the course, it starts with the part 1. We'll go through the option Greeks that are, kind of vital for the Butterfly Long Condor. The impact of theta, implied volatility, how that works, and the volatility crush, how that impacts these 2 strategies. How option pricing works, so you understand the time value and volatility component, how that's affecting the Butterfly. And then another part of the course that's really nice is I throw in, how I target, make targets for my trades. And this is what we call Fibonacci price target mapping using Fibonacci and standard deviations, so for laying out our profit targets and defense targets. So then in part 2, we go into exactly how, why, and when to use all the different variations with different trade examples of the long call or put butterfly, wide wing butterfly, broken wing butterfly, ratio butterfly, broken wing ratio butterfly, iron butterfly, the lotto butterfly, vacation, and long condor. So go through every different type of the butterfly, when to use it, how to use it, and then what are the best time frames for these types of trades, in the stocks and ETFs. So a lot of different examples to go through there. And then how do you get those, big, returns of 10 to 1 or higher, where you saw like on Tesla or GLD. So then, how the option pricing crush and theta decay come in to make the butterfly long condor, really work out with that, really accelerate theta decay into the expiration. And then we go into the monthly expiration, these butterfly penning trades. So these are really cool. You'll learn that in the course, and then go through the long condor, how to set the long condor up, how, why, and when it works. So really detailed part of that. So I want to make sure I get through everything. I think I have a few more minutes left. And then we've got part 3 is the progression of hedging. So this whole section of the course goes through how to use the butterfly and long condor to hedge core trading positions in defending vertical debit spreads and credit spreads. So a lot there in part 3, which is a really important part. And then, step-by-step checklist of when to use it, execution risk management, resource section of assignment risk expiration, how that works in a trading library. So just a really detailed, thorough course here. And so again, just the bonuses, you'll get my option beginners course here. So it goes through the benefits of options versus stocks, how time decay, how option expiration works, and then we'll go through a covered call strategy and a protected put strategy and a vertical debit spread in this course. And then you're going to get 30-day trial membership to my trading club. So you get access to my trading room from 9:30 to 10:30 each day during the week, Monday through Friday. Do a daily video newsletter every day after the close, and do weekly Q&As every week that are live and recorded. Trader Educational Wallet and 6% discounts off of all courses and software on my website, so you'll get that. And then we'll do a follow-up Q&A, which will be live and recorded. So you have access to that. Plus, you're going to get 30-day trial membership, right? So you can come in and ask any questions there. And then I'm going to give you one more option course here. It's a 60-page option guide with videos that covers the Greeks, the delta, gamma, theta, option pricing, standard deviations, just more, detailed, information and course content on that, the option side of things. And then last but not least, my 15 option strategy guides. So, what is a back ratio spread? How does that work? What's a ladder spread? Long strangles, short straddles, things like that. So you'll get that. And then one more thing, my option Greek handout. So this you can put on your desktop, telling you what the Greeks are. So a lot of great stuff there. Hopefully you'll take advantage of it. I think you're going to get your money back on this one super fast, and especially when we, enter markets like we're currently in right now. So make sure to sign up, and I sure look forward to working with a lot of you guys and gals in the future. And thanks for having me here today.